Robert, hi, good morning. Good to chat with you. Now, firstly, would you say that Indian markets have found a bottom and now we will only build on these levels, or do you think there is significant downside that India too will face along with the rest of the globe?
As you know, I have been cautious on Indian markets for most of this year, and the reason for that is that earlier this year I was concerned that the Indian market was discounting too much good news on the program implemented by the relatively new Modi government. Plus, valuations were starting to look really quite stretched at the beginning of this year. And we've had negative performance for most of the year on the Sensex. In terms of where we go from here, I think the economic news out of India is now looking much more positive, and I think most importantly, it's looking much more positive in terms of growth, in terms of inflation, relative to other emerging economies. And I think the other point to make is that whereas the market in the beginning of the year was discounting too much good news, that is no longer the case. And what was an overvalued market at the beginning of the year is actually now reasonably valued. I wouldn't say we've gone to being cheap, but certainly we're reasonably valued. So consequently, I do think that other things being equal, and we can't ignore the global economy and global markets, but I do think that we are forming a base on the Indian market. And, having been cautious for most of the year, my caution I am now reversing.
The Chinese PMI data also seems to suggest that that market is in a bit of a spot. Is China headed for a hard landing, and to what extent have the markets priced that in, Robert?
Well, I think the important question is how you define a hard landing, and I define a hard landing as growth decelerating to sort of around the 4% level. I don't think that's the case. I think for the rest of this year we will see Chinese growth close to 7% annualized. I think in the first half of next year we will be just under 7%. For next year as a whole, I think probably close to 6.5%. I think one important point to make is that the correlation between the Chinese equity markets and the Chinese economy is very low indeed. We've clearly had in recent months the bursting of what was a classic Chinese equity market bubble. Valuations were excessive back in April and May. All the classic symptoms of a bubble were in place. That bubble is now burst. We're now forming a base around 3,000 on the Shanghai Composite. I think that around current levels we'll probably see a period of consolidation in the Shanghai Composite. The Chinese economy, I think that the purchasing managers' indicators for October and November should pick up, and after that period of weakness in May and June, we'll see, at least in the short term, somewhat better data in China.
Do you see a compelling case for the Reserve Bank to cut rates later this month if the world is in a deflationary trend? Hard to imagine that India will remain in an inflationary one. Can the RBI move the needle this time around?
Well, obviously one of the big confusions in the Indian economy is this divergence between the different inflation indicators. What is clear in my mind is that yes, growth is accelerating, which would argue for the RBI to go reasonably slowly, but the impact of low energy prices and low commodity prices at a time when the weakness in the currency has been moderate is having a very positive impact on Indian inflation. So, consequently, I think the downtrend in inflation should allow the RBI to cut interest rates, and I think potentially another 25 to 50 basis points by early next year in terms of interest rate declines is likely, and that obviously is another reason why I think there is a flaw on the Indian market.
Right. So what is the message that the US Central Bank is giving markets right now, according to you?
Well, I think the message, as we discussed, is reasonably straightforward, although arguably it could have been communicated slightly better. Recently, we have had 4 Fed governors, including critical governors from Atlanta, from San Francisco, etc., all stating quite clearly their view that the federal funds rate will be increased by the end of the year. So I think you've got a reasonably clear message, although, in the September meeting, I think the market was confused with some justification. But now I think we're getting better clarity that there will be an increase from 25 basis points to 50 basis points by the end of the year, and that thereafter the pace of interest rate increases will be slow and the amount will be fairly small. So, that fits in with my earlier comment that the Fed funds rate, a central case forecast, would be 1.5% by the end of 2016, which compared with the state of the economy is still a very low interest rate.
Okay. Bob, before we let you go, just a word on how is India placed to weather the storm of global growth concerns?
Well, I think the important point to make at the moment is we have clear winners and losers from the fall in commodity prices. Most of the developed economies are winners, notably Europe and Japan. In the United States, the consumer is a winner. The energy industry is obviously under severe pressure. In emerging markets, likewise, those economies which are dependent upon commodity production are under severe pressure. And you see that in the performance, for example, of the Brazilian, the Russian economies, and in Asia, the intense pressure that one is seeing, for example, on the Malaysian ringgit and the Indonesian rupiah. Now, India is a consumer of commodities, so this fall in energy prices to $50 or less, the fall in other commodity prices, whether it be iron ore, whether it be copper, will result in lower inflation in India, will result in lower input costs, and arguably it is a net positive for corporate earnings and Indian growth. So whereas China is slowing down to less than 7% growth, Indian growth is picking up to above 7%. Brazil remains in recession, Russia remains in recession. A number of other emerging economies are obviously challenged at the moment. So I think one can make a fair statement that India stands out as one of the clear winners from this what is arguably the most important development in the global economy this year. I would also just add that I do think that investors are probably focusing too much on the negative impact of the fall in commodity.
Okay, Bob, we'll leave it at that. Thanks so much for taking the time out and joining us and giving us that perspective.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.